Hello, everyone. My name is Kathy McCory. I'm the CEO here at the Greater Issaquah Chamber of Commerce. I'd like to welcome you to our monthly webinar series. Today, we are honored to have Galileo Tan and Chris Richley from Harborstone Credit Union to share with us best tips and secrets and best practices for how to work on our credit as business owners. You know, we need to make sure our businesses have great credit, and that's always different than our personal credit. And so I'd like to thank both of you gentlemen for being with us here today. We are recording this webinar so we can continue to share it out as a resource for the entire business community. And we're honored to be able to do that for all of our members and our local businesses as well. And I'm just going to get right in there because I know that they've got a packed presentation here today. And I'm going to start by introducing Chris Richley. He is the branch manager with Harborstone Credit Union here in Issaquah. He was born and raised in Los Angeles, California, and Chris made the move to Washington State just over 7 years ago. After beginning his career in the financial service industry as a mortgage broker in 1997, he knows a thing or two about finances. With a passion for helping people, he works each day to be involved in the Issaquah community. As the manager of the Issaquah branch of Harborstone Credit Union, Chris works tirelessly to help anyone with their finances and builds relationships with them to succeed financially now and into their futures. Being a commissioner on the city's Economic Vitality Committee, or I should say commission, actually, sorry, and our committee's economic development, these connections have allowed him to help those he serves and contribute to the success of the community. And we thank you very much for that, Chris. And joining him here today is Galileo Tan. He is the program manager at Harborstone Credit Union, and Galileo has been a resident of Washington for the past 5 years. He grew up as part of an Army family and spent the majority of his childhood in Germany. 12 years ago, Galileo began his career in the financial service industry in Honolulu, Hawaii, after graduating from the University of Hawaii. Working his way up, he started out as a summer intern and joined a local bank full-time after earning his degree. Galileo received a bachelor's in marketing from Schindler School of Business at the University of Hawaii's Manahoa campus. Currently, Galileo serves on the boards of both the Filipino Chamber of Commerce of the Pacific Northwest and the Boys and Girls Club of King County. It may sound cliche, but Galileo's passion lies in helping businesses and watching their growth and success over time. He takes pride in helping businesses get financing to establish new locations and feels proud driving by a business's new location, knowing that he helped contribute to its existence. So I'd like to thank both of you and welcome you, and also thank you very much for your community service. I am so honored to have people that are serving boards and city commissions and Boys and Girls Club, and of course our own chamber. So gentlemen, welcome. I'm going to put myself on mute. I'm going to let you take it away. And lastly, I just want to remind our attendees, feel free to use the chat, enter questions as we go, and should we have time, we'll entertain those questions at the end of today's presentation. Thank you.
Thank you, Kathy. And hello, everybody. Good afternoon. Again, my name is Chris Richley, branch manager for the Harborstone Credit Union in Issaquah up in the Highlands. Been with the credit union for a little over a year. I'm joined by Galileo Tan, who's actually a program manager, but he's also got promoted to our small business manager, and he is the manager now of all our small business banking coaches. So Galileo serves both the North and South districts and supporting our money manager coaches that help our small business community. So I'm happy to have you guys in attendance to talk to you a little bit about credit, for business owners and how important that is for your business, and not only to either build it or establish it, but to continue maintaining it and grow it. So Galileo, if you want to get the first slide. All right, so one thing that we look at is where the businesses are at. So today in our presentation, we're going to be talking a little bit about, what do our financial institutions, not only credit unions like ourselves, but financial institutions, the bigger banks look for when they are extending credit to businesses. And there's 5 common themes. They call them the 5 credits, the 5 C's of credit that all banks and institutions pretty much follow. Yeah, they can deviate away from them a little bit. They can take in their own credit policies, but a majority of us use the same guidepost, I should say. And we're going to be covering those with you extensively today. And whatever questions you have, feel free to put those in the chat. And we also have a question and answer at the end as well. So jumping right in, the first C that we look at as an institution, and most businesses do, is what kind of credit history do you have? Now, a lot of people may think that's just personal, but we also look at what kind of business credit do you have? And so a lot of times I see a lot of business owners come in, whether they're new, established, we ask them, what kind of business credit do you have? And they ask why. They say, oh, I have great credit as a personal. I don't have any really as a business. So we do look at, the history of your paying your loans on time as a business in your business name. We look at how long you've had credit with the business established, and also have you had any negative reporting on your business side. So it's really important to look at establishing business credit in a way that, it's going to support your business, whether it's to influence, cash flow, which we'll be going over, looking at different avenues of how that credit history really supports the growth of your business and contributing to your success of your business. The next one we look at is collateral. So that can be a different means of how are we securing the business credit? Is it a piece of equipment? Is it a vehicle for the business? Is it something that a business building? Is it a commercial building? It's something that we basically look at what's tangible. It could be also monetary. It could be money. We have several businesses, startup credit, brand new to the industry, that can be secured by money that they have saved up to establish credit for the business. There's a difference between business and personal that we'll get into a little bit in the presentation, but that collateral piece may help a business establish financing quicker and obtain larger amounts on the collateral. So the collateral is something that we look at, is there something tangible to it? And it does it, and the interest rates can vary on that. So next slide. The next thing we look at is capital. So capital is something that funds that have to be injected by the business owner. We look at, as the industry, we look at how much skin do you have in the game as a business owner? Are you investing in your own business? Most businesses, a majority of them are started with the investment of the business owner. That's why they're small business. Everybody wants to live the American dream, but also looking at making money. How's that cash flow coming in, that first capital investment? We also want to look at the cash flow ability to create cash flow as the capital comes in, as your business establishes and gets going. How are you creating a strong means of cash flow into your business? Is it projecting to do good? Is it projecting to, continue to grow and strengthen over time? So that goes right into conditions. We look at certain things like the pandemic, for example. How is your business recovering or re-imaging or rebuilding during the time of the pandemic? What have you done differently during the pandemic to continue to strengthen your cash flow? What kind of suppliers and vendors are you dealing with? If you deal with suppliers and vendors that supply your business, the impact could have an impact to your cash flow. Those conditions, also combined with the products and services that you offer as a business, could be very well impacted. We also look at internal conditions, the ability of the owner to adapt to changing economics. We've seen an unprecedented time this last year and a half of whether or not we have adequate savings or we have adequate means to go backwards or back and influence our cash flow in a positive way. Some other conditions that we look at is if your business were to not have anybody come in to the business, no customers, no clients, how long could your business stay afloat? How long can you stay in the positive? Can it run on its own for a certain amount of time? Those are conditions we look at as a whole. So, Gally, I think you got the next one.
Yep, thanks, Chris. So I'll continue on here with the fifth C. And whenever we do this presentation, I like to say that we like to save the best for last, because in most cases, I'm not saying that this is true for all financial institutions, but for the vast majority of financial institutions, it's capacity that's their most important C of the five. But after I present this part, though, I will talk about what we look at Harborstone Credit Union as far as what we feel is the most important thing. So number five is capacity, and obviously that's the ability, right, for the business to pay back the loan. Whether it's a bank or credit union, you're always wanting to know, if I were to lend this money out to this business, what is their ability, their capability to eventually pay us back? So it's all about having a positive cash flow and making sure that it's consistent as well, as far as getting that positive cash flow in, so that you can make your monthly payments whenever that comes about. So one of the simple formulas really that we like to look at from the perspective of a financial institution is what's known as your debt to income ratio. And this is a very simple calculation that anyone can really do. And I have the formula right there on the screen. And you can do this not just on behalf of the business, but even on the personal side, right? If you're wondering, if I'm going to take on, for example, this auto loan, do I have the capability to adequately pay it back? And the calculation that we have on screen is you would take your total monthly debt payments and you divide it by your gross monthly income. So it may require a little bit of research, especially if you have hopefully you don't have a lot of debt payments. But if you do, though, you would need to go down that list, total that up, and then divide it with whatever your gross monthly income is. And what you'll end up with is a percentage at the end. And I'd like to point out as well that the percentages that we have here in the slide, this is generally what's acceptable for most institutions, but depending on where you bank at, I would always recommend that you speak with the banker that you're working with to find out what are the parameters that your bank or credit union is looking for. But generally speaking, though, the percentage that you end up with is how much of the monthly gross income goes towards paying debt. Now, the lower the percentage, obviously, the better. So as you can see here on our slide, anything that's 35% or less is definitely good. That's something that we would consider to be acceptable. The range of 36 to 49%, there's an opportunity to improve, but it may be acceptable. There's a little bit of risk there because you're nearing almost half of your monthly income going towards debt, but it may be acceptable, again, based on the risk tolerance levels of where it is that you bank at. And then anything 50% or more, you definitely want to consider lowering that first before you actually apply for a loan or line of credit, because there's a very good chance, again, I'm not guaranteeing this, but very good chance that you may not be approved if more than 50% of what your gross income is going towards paying debt. So definitely capacity, it's your ability to pay back whatever loan, business loan or line of credit it is that you're looking to apply for is obviously important. Now, on behalf of Harborstone Credit Union, I had the opportunity to speak with our business lending team to find out, of the 5 C's, is there anyone that they consider to be a little bit more important than the others? And the answer is yes. The one that I got back is character, and you might hear that a lot as well. It's oftentimes placed in place of credit history. Credit history and character really go hand in hand because it talks about the character of the business, right? Or in this case, the business owners, the guarantors that are on the loan. What is their history like? Do they have a history of making loan payments on time? Do they have a history of not making those payments on time? What does it look like? Because I always like to say that banks and credit unions were what's known as historical lenders, where we're going to base a lot, not all of it, but a good portion of our decision-making will be based on historical figures, because history tells us that this is the tendency that this business owner will treat credit in the present and in the future. Not saying that someone who was good in the past will necessarily be good moving forward. It could always switch, but that tends to be the case, really, is that if they have a history of making their payments on time, then there's a good chance they'll be doing so moving forward. So really, it's a character or credit history that for us is one of the important things that we look at. Credit score obviously is a part of that as well. But coming in close second is capacity. So character or credit history followed by capacity are the main ones that we look at Harborstone Credit Union. But again, to really get a more definite and accurate assessment, I would always recommend reaching out to your banker at whatever bank or credit union it is that you work that you bank at. That way you have the most accurate information possible. Okay, so that's capacity. It's kind of saving the best for last, right? Your ability to pay back the loan or lack of. So, and hopefully it doesn't go down that route. So we're going to have Chris come back on here again. And the next thing that we're going to be talking about are the different sources of credit that you can expect to get. So Chris, send it back over to you.
Yeah, thank you, Galileo. So now let's look at the sources of credit that we have available and most institutions have available. And again, to Galileo's point, if you have any questions as well, I would challenge you strongly to talk to your business banker. And that's something else that we look at is, do you have a business relationship established with an actual business banker, not a personal banker, but somebody that it works day in, day out with the business. So if you have that one go-to person, please go talk to them about what we talked about today, because I'm sure they're going to be excited that you got this knowledge and also you're coming in to them with questions, but that I'd also hope that they are coming and filling you with knowledge as a business owner to let you know what opportunities are out there for business lending. So the first source of credit we have are loans. Loans are our typical used for specific purchases. So you have a piece of equipment that you want to buy, supplies, a particular product or real estate. Those are going to be normally secured. They're fixed amounts or fixed payments, they're fixed terms. Those are fixed interest rates. And there's a term. Once you're paid off, you're pretty much paid off that debt. So, I mean, when you look at what type of purchases can you make with that? Again, equipment is part of that. A lot of businesses do not know about equipment. Their hair salons, your chair is actually considered to be an piece of equipment. A dental office chair, those are fairly expensive. That's a piece of equipment. Any type of equipment that you use within your business to whether it's to deliver like a truck or a car, that could be also considered a piece of equipment. So those loans are there to secure that type of equipment that you're looking to purchase and help your business get along. Again, they come with a fixed amount. Payments are based on a fixed interest rate and a term of the loan. Next one is line of credits. These are really good, typically used for emergency purchases. We've been talking about the pandemic, and one question that I've asked my business owners and businesses around is, what did you have as a backup plan? A lot of them look kind of complex, and I said, what have you used? And the go-to has always been some type of form of line of credit, whether that's a credit card or actual business line of credit. So typically are used for bridging the gap. When we say bridging the gap, we're trying to make ends meet, whether it's influxing cash flow right away into the business to help it continue to go, or it's influencing something to purchase, whether we need supplies to continue with our business, or it may be something we need to pre-order in order to collect on our receivables on the end of of a project, so to keep the project going. Maybe it's even making payroll, meeting payroll. Sometimes our business owners use line of credits for this. Monthly payments are different. They're based on outstanding balance as opposed to an outstanding balance of whole. It's what you utilize, it's what you're getting charged for the payment. You're also getting a fluctuating interest rate. So a lot of our line of credits have a variable interest rate, similar to credit cards and personal line of credits that you may have. Business line of credits are the same structure, in a sense where you only pay on what you have outstanding and you pay as you go. The beauty of a line of credit, though, is once you utilize it and pay it back, you have reuse of that. So that's why it's good for an emergency gap to use it. And again, it's good for instant cash flow. It's good for emergency situations. It's good as a backup plan. And it's also good to continue to establish that credit. On to the next.
All right, so I'll continue on here with some other ones that aren't as conventional, but we wanted to cover it anyway. Because we want to cover as much information and share as much of it as we possibly can. So the next one here is seller financing. Now, yes, you can get a loan from your local financial institution to get a vehicle or a large piece of equipment and things like that. And that's definitely something that we can help folks with. But sometimes, though, the dealerships or actual dealers that deal with vehicles, equipments, what have you, sometimes they might have special financing that financial institutions may not have access to. So usually there's going to be incentives such as a 0% interest rate, but oftentimes initially for a specific period of time. So maybe, for the first several months or so, first 6 months, it's 0% interest, and then there will be something afterwards. So that's one thing too that I would recommend looking at, especially if you're a business that might need some sort of vehicle, like a delivery vehicle or things like that. Oftentimes dealerships will have those special deals since you're getting it from them directly, as opposed to getting the financing through a bank or credit union. So it's definitely something to look at. Not saying that every single dealership is going to have incentives or special promotions, but oftentimes they do. So seller financing sometimes can help out a little bit better, I must admit, when compared to some banks and credit unions. So I just wanted to put that out there as well. The other one we have here is very unconventional. It's not something that's that you're going to see a whole lot of, but it does exist, and it's called factoring. Now, this only applies to businesses, though, that have accounts receivable. So, for example, let's say I'm a business and I perform services for my clients, but my clients don't have to pay me back immediately. Let's say I have what's known as terms, right? Where they have the ability to pay me back in 30 days, 60 days, maybe as long as 90 days. So I issued out these accounts receivables, and the expectation is that they're going to pay me back what they owe within a certain amount of time. However, let's say that me being that same business owner, I encounter something where I need that money upfront sooner rather than later, and I can't wait for the initial terms that I agreed with my clients. So let's say, for example, I have $20,000 worth of account receivables. Instead of getting that $20,000 piecemeal over time, usually it's 30, 60, or 90-day terms. Let's say I need that $20,000 right up front. A factoring company may come along and purchase those account receivables from me. So that way, they'll be the ones to front the $20,000 up front to me, and I can have it now sooner rather than later. And those clients that I have who do owe the monies on those account receivables will then pay that factoring company directly over time. So we're switching off places. I get the money directly fronted to me by the factoring company, and the factoring company will eventually get their money back that they lent to me with those account receivables that are now owed to them. Now, for something like this, though, typically there are going to be fees associated, and really that's how these factoring companies do make their money as well, is that, of course, they're going to get back what they initially lent to you, and they're going to make some profit up front from fees that they're going to charge. But for a business that does issue out accounts receivables, this may be an option, especially if you need that money sooner rather than later. So again, it is an option that's available out there, but it only applies, once again, to businesses that actually have accounts receivables. If they don't, then it really doesn't help. But we just wanted to point that out where, yes, that does exist and is another option out there. So not as mainstream as some other forms of credit, but it does exist. And we just wanted to make you folks aware of that as well. So that is factoring. All right, I'll turn it back to Chris here for some other examples.
All right, continue with our source of credit. A couple things, community development grants and loans. So different communities such as Issaquah, the state, the county, you know, there are a lot of opportunities to go through, and different nonprofits, believe it or not. We have one here in the Pacific Northwest called Business Impact Northwest that actually work within the community with the small businesses, especially startups, to get financing. A lot of businesses are new to credit, and so a lot of institutions, including credit unions, they look for at least a solid 2 years within business. So it's hard to get financing. So community development grants and loans is a good way to start as well. It also gives you different resources and abilities to get funds available for lending, usually provided by donations or grants money that's come from the government money that the states have. So please look into those opportunities. I know the chamber is a good resource for getting you involved with those opportunities, as well as the city. So if you have any questions, please reach out to them. And again, please seek out your personal business banker, and then they'll be able to, you know, also hopefully point you in the right direction for those. But again, most of them look at too, and most of the finance institutions look at how long have you been in business. For 2 years or more, you're typically going to have business relationships involved with those institutions. But continue even in as established business, looking at different grants and loans that are available even for your established business. And then the last source of credit we look up, and it is typically for startups, but then, you know, it's uncommon, but it's not as common as their investors. So normally startups, since traditional finance institutions may stay away from them due to risk associated with inexperience and lack of track record in the industry, some businesses may have to seek investors that are involved in that specific industry. And again, Business Impact Northwest has resources to get involved with those such investors, and also ways of getting different funding that way. Also, the investment portions, most of them are typically wanting their own principal investment back. So be looking at those terms and conditions. If you do bring on an investor, what are their terms and conditions? Are they looking into simply for their bottom line? Are they looking to, invest into truly your business, because it is your business? And then usually it's a long process because it's time spent meetings, you're giving presentations, you're pitching your own business, kind of like a Shark Tank almost, essentially, is how I look at it. But it goes back to, as we started, the 5 C's of credit. The most important is that character, is that credit history. Do you have a business plan established? Is that business plan, how is that projecting out 1, 5, 10 years from now to continue to create strong cash flow? And also, do you have established business credit? Ultimately, there's a difference between business credit and personal credit. Both are scored the same. They're both scored through the 3 credit bureaus, the major credit bureaus. So that's why it's so important, as early as you can get and establish business credit. That's what I would highly recommend you do. So next screen.
All right, so the next one here is the SBA, Small Business Administration. So one of the common misconceptions that most people have is, and I've seen this personally when we have people come into the branches and they'll say things like, hey, I want to apply for an SBA loan. How do I do that? So first and foremost, the SBA, what it actually is that it's an agency of the US government, which is basically the primary lending partner to financial institutions. This applies to both banks as well as credit unions. So the SBA has been in the news quite a lot, as I'm sure you folks have heard, with the pandemic that we went through. And in a way, we're still going through as well, where there was quite a lot of financing that was made available by the federal government through the SBA, whether it was PPP loans or any of these other types of loan programs that were available at that time. And so the way it works is that if you're a business owner interested in an SBA loan, you would initially apply for it at the financial institution that you bank at, banks, credit unions, what have you. You go there initially, and what your business banker typically will do is they're going to review what it is you're looking to do, how much you're looking to apply for, how you plan to use the funds, as well as a little bit of your background. So going back to what Chris and I were talking about earlier, looking at the 5 C's of credit, we're going to look at all of those things, right? Like, what is your history in dealing with business credit? What is your capacity? All of these things. It's a lot of information gathering, because the way it typically works is that just in case if there may be a few red flags, but for the most part, your bank or credit union feels comfortable enough in moving forward with approving your loan, in most likelihood, that bank or credit union will reach out to the SBA to inquire if they can lend a portion of the funds. Now, what I have here on the screen is that the typical split of funding is 50-50. That is true, but not in all cases. So I don't want anyone to be surprised that when you speak to your banker and you do get approved for an SBA loan, that the split may be different. It's possible sometimes that the split is 85-15, things like that. Now, what do I mean by these splits? 85-15, 50-50, there's 35-75 splits, all of these things. It's how much of the total funds you're applying for is actually split up between your financial institution and the government itself. So essentially what the SBA does is that they help take away some of the risk from financial institutions by injecting some of the money to help fund whatever type of financing it is that you're looking for as a business owner. So typically there may be a situation where a business hasn't been around yet for 2 years. And in most cases, financial institutions are more comfortable dealing with businesses that have been around for at least 2 years. Maybe a case where they've been around for a year, maybe a year and a half, so close enough. But the outlook looks positive for that business based on their previous history. So in that case, their bank or credit union may be like, you know what, it looks like we're going to fund a portion of this, but let's inquire with the SBA if they can fund the other difference. Again, whether that's a 35-75 split, 85-15, 50-50, what have you, all of these things. So really, that's where the SBA comes into play. However, though, one thing to keep in mind is that, and I'm sure we're all aware of this, when you're dealing with the government, right? Whether it's the local government or the federal government, it takes time. And just in this case as well, the application process, getting approved, going through a lot of paperwork, it does take time. And there are also going to be some additional fees that you'll be paying from not only your financial institution, but on behalf of the SBA. So it is a timely process. It's something to be aware of, especially if you're in a time crunch, when you have a specific deadline that you need the money by based on what you plan to use the money for. So just some things to keep in mind. Now, there are some various lending programs within the SBA. So oftentimes it's very difficult. I'm not going to say that it's impossible, because it's not, but in most cases, it's very difficult to get financing from a bank or credit union if you're a startup. As Chris just covered, there are other options for that, such as getting investors to help start up your company. But if you're going in with no money, with no skin in the game, right? You're not injecting any of your funds whatsoever. You want 100% financing for a dream that you have. It's very difficult to get that done on your own and through the bank or credit union that you're at. However, though, the SBA does have programs that can help with startups, but also for minority-owned businesses, female-owned businesses, or those who once served in the military and are now looking to start their own business. So there's a lot of programs out there. There's more than what I just mentioned, but those are some of the more common ones usually that we'll see out there. So it definitely does, it's going to help you to talk to your banker and find out through your banker, hey, what programs does the SB have that possibly we can take advantage of based on the background of the ownership group that's looking to apply for the loan. So again, I want to put that out there that the SBA has been very helpful actually during this past pandemic, whether it was a PPP loans, the EIDL loans, there was all kinds of different programs to really help businesses through the trying times we had with the pandemic and are still going through, right? But looks like, knock on wood, that the business economy side of things anyway is improving a little bit compared to where we were maybe a year and a half ago. So again, the SBA, we kind of want to put that here at the end because it is a major financing partner of financial institutions, and definitely worth your while to inquire about with your respective banker when you have those conversations. So that's the SBA, Small Business Administration. And we are going to continue on to the next one here. And Chris, I'll turn it back to you.
Yeah, so to wrap it all up towards the end, looking at financing and collections, there's a couple things that typically happen. What happens if you do have inconsistent credit or so-called bad credit or challenge credit? It can go to collections for your business just like it does personally. They're sent to a third-party debt collector, and they require you to pay them off. Normally within 6 months or of non-payment, we're sending you to collections. Typically stays on your report for 7 years. 3 major credit bureaus. Again, business credit's reported to all 3 credit bureaus: Experian, Equifax, and TransUnion. That's another big factor because personal credit only gets reported to where that company wants to report it. They have a choice. Business credit is reported to all 3. So when you look at business credit as a whole, that's why it's important to get it early and maintain it for the business name, because it also establishes business credit for your business, not you personally. So that's why it's really important to maintain and sustain a good amount of relationship with your credit, paying it on time, securing the terms and conditions that work best for your business cash flow, creating a budget within to save that cash flow to make those payments on time. So we're not having to go back to the SBA to collect on unpaid debt. We're not having to go back to, collections and hiring a third party to collect from the business itself. So again, that's part of the financing and collections. If we do default, if a business does default on a loan, it's handled a little more stringent than an actual personal credit, but it is the same almost as far as 7 years on the business, and it does not go away. So, and Gala, you want to cover the last 3?
Yeah, definitely. Thanks, Chris. So the last 3 here that I want to cover also, the fourth one, but the first one I'm covering, I'd like to really emphasize is that if you're a business owner and you're going through tough times and you can foresee that you're going to have a hard time making payments on a loan, maybe next month, next 2 months, next 3 months, whenever, It's always worth your while, and it never hurts to be honest as soon as possible, and having a conversation with your banker and letting them know that, you know what, based on trends, I think I'm going to have a hard time making these payments coming up at around this time. What can we do now where it'll benefit both of us mutually? And I can tell you right now that based on my experience, a lot of banks and credit unions truly appreciate this. Now, will it work every time? The answer is no. It's not always going to work, but they will be willing to work with you though to see what can be done. So for example, I'll give you folks a quick example here. One of my former clients from years back when I was still banking in Hawaii, where they could kind of foresee some economic troubling times coming up ahead. And they knew that in 6 months' time, they would have a very difficult time in making their monthly payments for a loan that they had. So the owner of the business came to me at the time. I was their business banker, and we spoke with our credit folks in the back office and said, is there something that we can do, considering that these clients of ours have been with us for a long time, they're being honest, and they're telling us in about half a year's time, they're gonna have a very difficult time in making these payments based on some things that were starting to happen in the business. So what we did was we lowered their monthly payments and we extended the term. So eventually we're gonna get paid back what we were looking to get paid back, but we made it easier on our client by making the payments a lot lower than what they would have paid. From what I can remember, I think it was more than half of what their payments were. So it really helped out. They were still able to make their monthly payments, but now they weren't so pressed to make sure that they had X amount of dollars every month to make payments on this huge loan that they had with us. So it worked out in the end. It saved their business from closing. The bank still got its money back eventually. It was just extended over a longer period of time. So it is possible where you can do things like that, where you can make adjustments to monthly payments, or even possibly not make payments at all. I know here at Harborstone, for a personal side though, we do have this thing called Skip-a-Pay, where you can use it a maximum of 2 times within the 12-month period, not make a payment during a certain month, and you won't incur late payments, and you also won't be reported to your to any of the credit bureaus that Chris mentioned here that's going to affect your credit in a negative manner. So it's one of the benefits we offer to our client, to our membership, called Skip-a-Pay. Again, they can only use it twice every 12 months. And all what that basically does is that it just takes a payment that they missed, and we just extend that over to the end of the term that we have for the loan. So we will eventually get paid back that money, but it makes it easier for our members if they are going through hard times. So first and foremost, talk to your bank, don't hide from it, don't run away from it, and see, hey, is there anything that we can do to make it benefit both of us still, but by making it easier for them. So always have those conversations. The other thing here that I have is that all of us, we're entitled to a free credit report once a year through annualcreditreport.com. I know there might be a lot of commercials you're going to see out there where it's saying free this, free that, but in reality, you might be able to get some of your information. And if you want the entire picture, you might, they'll actually have you pay a fee. So annualcreditreport.com, it's at no cost. You can get everything up front. Do it once a year is my recommendation. And the reason why is you want to make sure that there's nothing on there that's a surprise for you. Even if you have no plans of applying for any kind of financing in the near future, you still want to make sure that everything looks as clean as it possibly can be, because if not, it does take time and a lot of effort to clear away things. I mean, as Chris mentioned earlier, if you have any kind of negative reporting, it could stay on your credit report for up to 7 years. Another quick example here, I had a business before that applied for a loan. It was between 3 owners. One of the owners, their credit score wasn't very good. He was totally surprised by it, and it was discovered when we actually did the application and had to decline it because of his low credit score. And then in pulling up his credit report, there was a lot of negative reporting that he wasn't familiar with. It turned out he was a victim of identity theft and wasn't aware of that. And there were people out there using his name for other loans and credit cards and not making those payments that he had no idea about whatsoever. So we discovered that, but it did take a long time for things to get cleared up, though, a very long time, to the point where he, along with his other 2 business partners, decided, you know what, I'll be temporarily removed from the business. And they restructured the ownership so that the business can move forward in getting the loan and doing what they need to do, and not have him kind of hold everyone back. So I recommend this for everyone, whether you're a business owner or not, to go to annualcreditreport.com once a year, check out your full credit report, and then just make sure that everything looks the way it should be. You know, that there's nothing on there that you didn't know about. I mean, that's the worst thing, right? When you have late payments on a credit card or on a bill or whatever that you never applied for in the first place. When you do go to it, it will give you the option, as Chris already mentioned, of selecting from any of the three major credit bureaus. I would recommend just selecting all three. For the most part, they're similar, but there might be slight differences with each one. And again, you want to make sure that you have as large and as clear of a picture as possible on what your credit is, because as we talked about earlier before, there's both personal credit scores as well as business ones, right? And the two are totally separate. And that's kind of just goes into the last thing here, where review your credit report on a regular basis, such as yearly. You know, that's we can't emphasize that enough for you folks to check it out. And with that being said, you know, we are really at the end of it. We have, I believe it's going to be questions now that we have here. Let me just make sure. Yeah, so questions. With what time we have left, we're more than happy to answer any questions you folks may have.
Okay, great. Thank you both. I am going to suggest right now, if there are questions, you can either raise your hand and I will unmute you, or you can put something in the chat that you'd like to ask a question. And again, I will unmute you. In the meantime, I'd like to start with asking a question. You guys covered a lot of information. This is great. I did have some questions around SBA loans and things like that. You know, many of us last year applied for the PPP loans and have since been given forgiveness. So my question is that, did that do anything to help our credit reports? I mean, we did indeed get loans with the SBA and they were forgiven. So is that the same as being paid back in full? What does that look like for a business's credit report?
Yeah, I mean, it definitely looks good on the credit report because, you know, the PPP loans, in my personal opinion, is that was a positive for everyone involved. You get the money you need to, you know, to work with it however you need it to, but you don't have to pay it back. So because it's forgiven, essentially the way it's going to be reflected, from my understanding anyway, is that it will be along the same lines of you having paid back your loan. I mean, it's been forgiven. So really, there's no payment really involved with it. It can't hurt your credit report. So whether they choose the financial institution that you got it with, whether they choose to report it or not, it's either going to be a non-factor or it's going to be a positive factor where you got the monies, but then it was paid back per se without you really paying it back. But because you met the criteria in order for it to be forgiven. So it's not really as clear cut as you really extending out the money. Here you go, thank you, SBA, we're paying you back. But you did what you had to do to show that you don't have to pay it back. So again, to answer your question, Kathy, it's either going to be a non-factor where it just washes itself out, or depending on how it's reported by the institution you got it from, it will be viewed as essentially paying back on the loan in a timely manner. So can't really hurt you with the PPP loan, unless you weren't forgiven, you had to make payments and you missed those payments. But from my understanding, most people were able to adequately meet the guidelines to have it 100% forgiven.
Okay, thank you, Galileo. And that leads to the second part of the question is, again, last year during the pandemic, SBA also had the EIDL loans. And now, thanks to a new funding mechanism, SBA is coming out with yet another round of small business loans. And so these are low interest. But with the loans that were issued last year, they're not requiring payments to start back until June of 2022. So again, is that hurting, helping, or having no impact on a business that has a loan, they've been funded, but they don't have to start paying it back yet? Interest is accumulating, but again, what does that look like to a business credit rating? Is it nothing? Is it something? Is it hurting? Because I haven't even heard from the chamber's perspective if a business can start going ahead and paying back those loans early.
Yeah, so as of right now, not until the first payment is due, Kathy, it's not doing anything credit wise.
Okay.
Because there's been no record of it yet, right? Really, your credit score goes up when good things happen. It goes down when bad things happen. You receiving the funds from the SBA is from a very neutral perspective. It doesn't really help or hurt your credit score. Not until the payments begin, and then they start to see, forever how long the term is. When you're making those monthly payments and you're making them on time or not, is when either it'll help or impact your credit score, whether positively or negatively. So between now and then, it's not really doing anything, but not until payments start. And again, it's on you, the business owner, and how you treat it. We'll determine whether it's going to be positive or negative. But yes, the SBA has been very good to a lot of businesses recently. I agree.
Okay. Oh, absolutely. We're very appreciative of that. I don't see anything popping up in chat or anybody raising their hand. So I will say I have one other question that as a business owner, I have kind of struggled with in the past. And that is when you touched on lines of credit, including credit cards. Can you offer up any suggestions as to how to go about getting credit cards that don't still require being associated with your own personal Social Security number?
Good question. So a lot of times you'll financial institution or credit union, when you establish a business account, they're going to ask you for your tax identification number. Even if you're a sole proprietor, I would strongly suggest getting that. Of course, talk to your accountant, but it's pretty much going to be factored into a couple things. When you're establishing your business credit or your business accounts, a lot of institutions, including Harborstone, can almost essentially pre-qualify your business for an instant credit card. They're not underwritten as constituent. If you were to come back later and say, Chris, I want a credit card, or my member comes back in 6 months and says, hey, I need a credit card, then we got to fully underwrite it. So any instant offers that you get, like that type of offer, like an instant credit card as a business, I would highly recommend taking them, because that is instantly establishing business credit. Now, to answer your initial question around, is it affecting your personal score? It does not. However, most institutions, including Harborstone, require that personal guarantor, which we do look into some factor of your personal credit on top of the business credit. So we're not using essentially your Social Security number for the business credit per se right off the start. We are using your social, but as it goes and we continue the relationship, your business tax identification number is essentially your identity for credit as well. It's reported to the credit bureaus just as your social is. So it's kind of two-part. At first, we are using your actual Social Security to get everything established and your TIN at the same time. If we get instant offers, that is going to be almost strictly based on your personal credit, or if you've had some type of established business credit, of course. As your relationship gets growing and your business grows, then we strictly can factor in on your basis of your tax identification number and your business tax returns and your business cash flow and your capacity and your capital. That's where the 5 C's of credits really start coming in, and we really start separating between the personal credit and the business credit.
Okay, so if I'm hearing you right, I just want to make sure when I'm going for those credit cards, if it's not one of those free offers, as you mentioned, that they're asking for both my tax ID number, my EIN number, as well as my Social Security number, so that my business is getting some sort of credit rating from
Correct.
the use of that credit card.
Absolutely correct. That's why we also highly recommend, even if you're sole proprietor, that you establish a tax identification number. So then at that point, you are establishing business credit as well as your personal credit. It also takes into factors a lot of liability. So if you're a limited liability company, that also personally, if you're continuing to use credit on your personal side, it can almost break your limited liability that you're putting on yourself. A lot of companies get a limited liability because it takes the personal liability off of the company or off of you personally only and puts it on the company. So again, you want to establish business credit for that liability to keep those separate. You want to keep your business and personal separate. So yes, we
Right.
do run it, but it is essentially building credit on the business end. Eventually your business credit's going to get strong to where Galileo's point earlier, we start factoring that in more than your personal credit.
Right. Okay. So Chris and Galileo, I want to thank you. Again, I don't see any more questions out there, but I do want to ask, is there a way that people who may watch this at a later date that they can reach out to the two of you?
Yeah, definitely. So I'll start with myself. You can reach me via email is the best way possible. So that's going to be galileo.10@harborstone.com. So it's my first and last name separated by a dot. So again, galileo.10@harborstone.com is the best way to reach me. If you have questions, you want to chat, feel free to reach out and we'll go from there.
And then mine is also my first name separated by a dot, but it's actually Christopher. So Christopher, CHRISTOPHER .Richley, REICHLEY @harborstone.com. Or you can also come up to the Highlands and visit me at the branch. We're open. I'm happy to see you anytime you walk in. We're open Monday through Thursday, 10 to 5, and Fridays, 10 to 6. We're right next to Ben & Jerry's. If you like some ice cream, you can go support that local business and have some ice cream. I know Galileo likes to do that, but we can also go to the coffee shop and sit down as well if you don't feel comfortable sitting in a banking environment and sharing your information. But I'd love to talk to you personally as well up here at the Harborstone. Or if you have any questions, feel free to email me as well.
Great. So wonderful. Again, Galileo, Chris, thank you so much for this valuable information. And we're going to go ahead and wrap things up, and we'll be sharing this and adding this to our library of wonderful videos to help support the business community and help you be successful. So thank you both once again.
Thank you.
Thank you, Kathy, for the opportunity. Appreciate it.
Okay, thank you. And on behalf of the Greater Issaquah Chamber of Commerce, I'd like to thank all of you for joining us today. And again, if you're watching this later on down the road, if you have any questions, please don't ever hesitate to reach out. We are here for this purpose of serving our business community, which is each and every one of you. Thanks again, and have a great day.